It was, human intensive labor to make.
Yeah.
So it's scarce. But then unlike other big scarce things like meat or spears or something, it was portable.
Yeah.
It was
Yeah.
small, dense, and importantly, you could wear it, so you didn't have to have it in your hands.
Right.
And that set of traits, served as money. And obviously, as we got into gold mining, that became the new sort of ornamental, even more dense and even harder to make.
Yeah.
But that's kind of the natural progression that humans have gone through.
Hey guys, welcome to Everyday Finance. There is a powerful framework that Lyn Alden provides for understanding Bitcoin that goes beyond the daily price swings and is rooted in the fundamentals of international economics. She emphasizes that in order to make intelligent investments, one must have a comprehensive understanding of the international financial system. Central bank policies, debt cycles, currency debasement, and geopolitical trends are all intertwined with the larger picture. Bitcoin, in her opinion, is not an asset that can be used to make money quickly. Rather, it is a strategic hedge against the long-term instability of the system. Alden helps investors build conviction in assets such as Bitcoin by gaining an understanding of the reasons why these assets are significant in a world that is dominated by inflationary pressure and a declining trust in fiat currency. This is accomplished through the study of history, data, and economic cycles. Her observations are a rallying cry to broaden our perspective and observe Bitcoin not as merely another trade, but as a tool for the preservation of wealth in the midst of global financial uncertainty. Right here is where you should begin if you want to navigate the cryptocurrency market like a savvy investor.
So I view money as the best ledger that people use in order to keep track of savings and transactions. And ledger itself can have multiple meanings. The reason I phrase like that is to try to combine the commodity theory of money with the credit theory of money rather than have them kind of speak past each other.
Okay.
And so we often think of money as a physical thing. Whereas in the modern era, it's often a ledger, like something that is just our bank account has a ledger. The banks have, a central ledger between them. But in the book, for example, I talk about some informal ledgers. Like people can have small groups and they keep mental track of kind of who owes what. That's often like an easier way to kind of ease around barter is just by having that kind of informal credit system. So whether it's letting nature itself be the ledger, which is what we do when, for example, we have gold and silver coins, for example, or having some sort of human construct as the ledger. It's basically whatever's the most saleable thing that humanity's kind of using at that time, which has there's technological details that go into what is the best money. There are certain political realities that happen during periods of time that determine what is the most used money. But basically, it's the ledger that people are either they have to use because it's forced on them, or the one that they're choosing to use from a bottom up perspective to keep track of who owes what. Basically, nature serves as the ledger manager for the token system. And basically, even though that's it, what's unique about the token or natural ledger is that there's no one person or one group that has the full snapshot.
Right.
And yet that still exists. There is an objective number for how many gold coins are in a given region, even though no single person is sure what that number is per se.
Yeah.
But that number still exists. And so as that gets updated by physical possession, that's one way of tracking a ledger. Now, it just contrasts with most of the ways we do ledgers.
Yeah.
But that's one of the ways to kind of just unify those two concepts and see why they're not totally different things. They're just kind of different functions of an underlying similar principle. Slow, and then to some extent it even had scarcity issues that you could still make more of it. So I think if we imagine the Platonic ideal of money, it's a perfect ledger that can't be corrupted, and we can just beam it to each other. We can just teleport it around with no friction.
Yeah.
Now, obviously, the Platonic ideal does not exist. So the question is, how do you get as close as possible to that?
Yeah.
I think in obviously the current era, the closest thing we have is Bitcoin, and that actually gets quite close to the Platonic ideal.
Yeah.
And going back in history, it's like the bottom-up nature is fascinating because you've got multiple cultures that kind of come to similar conclusions, and they don't even articulate it the same way, and yet it kind of reemerges time and time again. So going back to Nick Szabo's essay, The Shelling Point, and other kind of research at that time, it showed that hunter-gatherers often used jewelry beads as an early form of money.
Yes.
Because it served a lot of similar functions. It was human-intensive labor to make.
Yeah.
So it's scarce. But then unlike other big scarce things like meat or spears or something, it was portable.
Yeah.
It was small, dense, and importantly, you could wear it, so you didn't have to have it in your hands. And that set of traits, served as money. And obviously, as we got into gold mining, that became the new sort of ornamental, even more dense and even harder to make.
Yeah.
But that's kind of the natural progression that humans have gone through. It's the best commodity for it. So basically, as all the different technological groups come together, the ones with better technology can make more of the other one's money. They can't make more of the technologically superior culture's money. And basically, when you kind of iterate through that, when all the different cultures of the world kind of came together and kind of evened out, gold and to some extent silver basically beat all the others. They have the highest natural stock to flow ratio. They have like the longest durability. The kind of the most dense you can kind of get for the most part. And if you go into even rarer things than gold, then you run into liquidity issues. Like people could technically use meteorites for money, but they're not fungible. They don't have a lot of the traits, even though they're super rare. So it's kind of getting as scarce as you can get before you actually start having issues related to the other metrics of money. And that's why gold is that sweet spot. And the only limitation of gold is, one, it was slow. And two, it wasn't as divisible as people would like it to be. It's hard to, make a small enough gold coin that you can make it like an hour of someone's work or, and so that's where silver was common as well. So you'd have that kind of bimetallic, standard combined with some of these other informal ledgers. If you need to break things up, you can say, well, you do this for a little bit and you'll owe me one piece of silver, for example.
Yeah.
After a sudden and unexpected geopolitical jolt, the markets were thrown into disarray. This time, the jolt came from current and former President Donald Trump. Through his Truth Social platform, President Trump asserted that the United States is aware of the precise location of Ayatollah Ali Khamenei, the supreme leader of Iran, and referred to him as an easy target. Despite the fact that he added that there was no strike planned for now, the phrases were taken very seriously by the entire world. Only a few days had passed since Israel and Iran had rekindled their tensions by exchanging missiles and drones over the past few days. The comments made by Trump added fuel to the fire of global concerns that were already on fire, and the cryptocurrency markets felt the effects almost immediately. The price of Bitcoin dropped from $14,310 to $13,553 in just 1 hour, and then it rebounded to a price of $15,450. The price of XRP followed Ethereum's lead and fell by 1.3% to $2,462 USD. For the first time in several weeks, the Crypto Fear and Greed Index experienced a decline of 16 points, moving out of the greed category. The sentiment of the market became more cautious as traders prepared themselves for additional instability. While some analysts are predicting a further decline below $100,000 for Bitcoin, others are stating that the recent rebound demonstrates the underlying strength of the cryptocurrency. In any case, one thing is abundantly clear. The cryptocurrency market is no longer a separate world. Rather, it is deeply connected to the stage of the global economy.
One of the main things it did was it kind of killed silver. That was kind of silver was hanging in there for a while as like the second best money. But once both gold and silver became divisible in similar ways, silver's primary advantage to gold was basically abstracted away.
Right.
Now there still was advantage of having gold and silver in your own possession. As we saw, all the issues of gold-backed paper all defaulted eventually.
Yeah.
But as long as people were using those systems, it was like, well, if gold and silver are now equally divisible by extraction, then why do we need silver for anything?
Yeah.
And any cultures that kind of hung on to silver longer than they should have, it got to the thing where people that had gold could debase silver quicker than the other way around.
Right.
It's not as high of a stock to flow. And then over the long run, it even kind of overtook gold because we basically levered the system so much that when we actually dropped gold from the system, instead of the rest of the system fully collapsing, we actually to this day are still using these abstractions because we live in an age where speed actually matters for the first time in most of human history.
Yeah.
I think that was a really big component because that made it seem like natural to happen. But I think that the other principle was this actual technological limitation of gold, which is as the world became connected by telecommunication technology. So the telegraph, invented in the 1830s, deployed cross continent and then across the Atlantic Ocean in the 1860s. It actually wasn't cross Pacific until like the really early 1900s. Then of course radio and telephone and internet. As we kept speeding everything up, gold was just not quick enough. So we were kind of using these, paper ledgers, but then they're run by humans and they break them. But then the funny thing is, for example, when you see it's in a developing country, if their currency breaks, usually rather than going to gold, they go to like dollars or something. They dollarize more than goldize. Now they still use gold often for longer term savings, jewelry, or stashed away in some context. But for their actual medium of exchange use, they often fall toward a stronger fiat currency because we live in this age where speed is relevant, which wasn't really the factor before the telegraph. We can think of it in terms of magnitude, and there's three major eras. So before the telegraph, there were ways to speed up gold and silver, but they were very limited. So like things like coinage speeds up transactions. We don't have to sit down and count grains of gold. We just
Standardization.
we have standardization. And then things like the invention of paper over papyrus, then bookbinding, and then the printing press. That basically drastically lowered the cost of encryption. We often think of encryption as a digital thing, but basically you need kind of, in that context, pieces of paper that can't be forged easily. And that's where things, and that are inexpensive. And that's where things like the printing press and paper were actually technologies at the time. And those things functionally accelerated the ability to transfer, gold and silver around more safely, more efficiently, more quickly with some degree of abstraction or other things.
Yeah.
But it was still obviously it's still literally moving at the speed of matter, just a little bit quicker at the speed of matter. What the telegraph did is it's completely blew open the divide where people on two different continents could agree to make an exchange because a transaction is basically just an IOU.
Yes.
Whereas final settlement could not be done at that distance. It would take, weeks, months, even years of shipping the gold, auditing it, something that just wasn't frequently done. And so what that did was that gave a ton of power to the entities that were running this ledger, the middlemen, basically.
Yeah.
And that was the banks, and then by extension, that was the central banks. And because those are really big honeypots, the government can just kind of say, well, we control that now. And so by having that kind of speed mismatch, it kind of put all the incentives toward that centralization and breaking.
Yeah.
And so now we're in the third era where after, for the first time, we actually have fast settlement. And the reason that came so much later is because you need way more bandwidth. You need more computation, more types of algorithms and encryption and all that. So it kind of just took orders of magnitude more stuff than simple Morse code. But we're finally in this period now where actually you do have, instead of this huge gap between transaction speeds and settlement speeds, we've caught settlement 90% of the way there. There's still the difference in speed between, say, Lightning and eCash versus Bitcoin, but it leads back to that really close gap where any sort of centralized middleman has way less power now, again, which is healthier. And we went through an era where that was kind of this inevitable concentration that happened. One of the analogies I make is that when hunter-gatherers basically developed agriculture, went into civilization, there's this period of time where they actually had lower life expectancies than the hunter-gatherers. Now, they had other advantages, like they proliferated and were able to, conquer the hunter-gatherers, but on an individual per capita basis, in many ways, quality of life went down for a period of time, and there was like this kind of trench they had to go through until they got to such point that they had medicines and electricity and running water and stuff, and then they finally were able to kind of actually have a fully better experience for the most part, and kind of money went through a similar valley that was kind of inevitable.
Even though the cryptocurrency markets as a whole were shaking, Ethereum was able to maintain its stability in a surprisingly strong manner. Although there was a significant drop of 15% earlier in the week and a total liquidation of over $270 million, Ethereum, ETH, managed to stabilize near the $2,400 mark, which indicates that long-term holders demonstrate resilience. One of the most important reasons? there is a surge in activity on Layer 2. Ethereum is being scaled by networks such as Base, Arbitrum, and Polygon, which are making transactions more efficient and less expensive, luring users away from the main chain, and improving the usability of Ethereum in the real world. Shopify even introduced USDC payments on Base, which came with cashback incentives, which added fuel to the fire of adoption. While this is going on, Ethereum balances on centralized exchanges continue to decrease, which is a typically bullish sign that indicates there are fewer tokens available for purchase. On the institutional side, a fresh $830 million flowed into Ethereum exchange-traded funds, ETFs, listed in the United States, which is another vote of confidence. Even though Ethereum has not yet reclaimed the peak price of $2,880 that it reached earlier in the week, the fact that it stays above $2,400 indicates that the market is not panicking, but rather recalibrating. At this time, the data from futures indicate that sentiment is neutral, which typically comes before a new trend. For the time being, Ethereum's relatively low-key strength may serve as a glimpse into the future of cryptocurrency once the storm has passed.